What's going on, guys? Welcome to the Creating Wealth Podcast, where I, Kyle, from Kyle Curtin Real Estate, interview local top dogs in the real estate investing, wealth building, and personal finance industries. Let's build together. What's up, guys? The guest on this week's episode of the podcast is doing some really big things and has an amazing investing story so far. This is part one of the two-part interview because there is so much that we covered. Michael has owned and operated a hair salon franchise, was active in the short-term rental space, and is taking on much bigger commercial projects. In this episode, we get into Michael's experience in the franchise game, reusing your same investment principle over and over again, compounding lessons into your next projects, and so much more. There is a super interesting story in this episode, and I hope you enjoy. Let's jump right into the episode. What's up, guys? Welcome to episode 46 of the Creating Wealth Podcast. Today, we have the great pleasure of chatting with Michael Parks, the manager of the real estate syndication company, Spire Investment Properties. They're out of Boston, and he is as well a licensed Massachusetts real estate agent. What's going on, Michael? How's everything going? What's new?
Awesome. Thanks, Kyle. I appreciate the introduction. Everything's going super. It's a great Friday here in Boston this summer.
It definitely is. Guys, we were just talking a couple minutes before I hit record and about how nice it is right now and how it's not currently raining at the moment.
Yeah.
But in an hour, it probably will be.
The way it's going this year.
Yep. But yeah, Michael, so, if you could kind of start to jump in with how did you get started, in real estate altogether and, that kind of entrepreneurial, what kind of gave you the spark?
Yeah. Well, I think, I've always had this entrepreneurial spirit, and as much as I've loved my day jobs that I've had, I've been a technology professional for many years and running IT departments. But I've always just had this desire to run my own business. And I started that actually back in 2008 in the Great Recession and said, well, I really would like to start my own business, but I'm not ready to leave my day job. So how do I create a business that is, can largely run on its own, and I can manage the business without being in the business? And I looked at a lot of different options back then. I consulted with a franchise consultant at the time. I thought maybe a franchise would be a good idea because it's a proven business model and you just need to execute it, right? And I'm a good execution guy. So I ended up, believe it or not, purchasing hair salons. Of all things, hair salons. Like I don't cut hair. Like I don't know what made me think that this was a great idea, but actually I do know what made me think it was a great idea. It was the fact that I couldn't cut hair, and therefore I had to work on all the business aspects of the business rather than operating the business in their day to day, because I couldn't teach people how to cut hair, let alone do it myself. Um, so I did that. A couple franchise hair salons that are, a large brand in the industry. Opened two of them here in southeastern Massachusetts, and got them up and profitable. Learned a ton about recruiting. Learned a ton about marketing and how to operate a business. And it was a great experience. Got them profitable, but it just wasn't going to scale to a place where I could see myself doing this full time. And I was lucky enough, and real estate became tight at that point. By the time 2012 rolled around, all those retail spaces that were once vacant filled up. And so it was really tough to find great real estate locations, which is a key for a hair salon business. So I had the opportunity to sell it at a good profit. And I said, okay, that was a great experiment. Made some money and learned a ton, but this isn't the business for me to keep moving on in. So that was my first experiment into entrepreneurship and trying to build some passive income.
Wow, that's absolutely incredible. Oh my God. How was that in kind of getting into the franchise space? That, I don't really know much about it at this point, but do you kind of need a lot of capital to start off to open a franchise, or how does one kind of go about that?
Yeah, so every franchise is different in terms of how much capital you need, but yeah, you definitely need, this isn't you don't bootstrap it. Yeah, I mean,
Yeah.
you're going to need to So a hair salon, it's a few $100,000 business to get into, and that's you're signing leases lost in five. I mean, I was signing 10, 15-year leases. That was signing me up for literally $1 million of liability. And so you had to have enough credit to be able
Yeah.
to sign up for that too. um, and so yeah, you need to have some capital to get started. You need to purchase the franchise itself, right? So there's a fee for that to get into the franchise, and those will range anywhere from, the ones I looked at from 25 to $100,000 to purchase the franchise. But then you got to pay for the build out of the space, all the equipment. You have to, depending on the business, it may not be profitable day one, and that's the case with hair salons. It takes a while to build that business, so you have to build it up to profitability and be able to carry the losses until you get to profitability. You have to over invest in marketing. So there was a whole business plan that was put together, and the franchise helps a lot in putting that together because they know how the numbers should work.
Yeah.
So they help you build your business plan, and then you go execute it. And that's the thing that it just sounds easy. Just follow the formula, just execute, just do the steps, right? Well, yes and no. I mean, some of those steps are particularly hard.
Yeah.
Like that, they would say, well, just hire a manager to run your hair salon. And then that makes all the sense in the world. But if you think it's easy to hire a manager that knows how to cut hair, knows how to teach people to cut hair, knows how to, in many cases, be, you know, kind of a big sister to many of the other hairstylists that have challenges that they need help working through so that they can come to work and be productive, and have enough business sense to be a manager of a hair salon. That's a hard thing to find.
I
That is
bet.
a very hard thing to find. So it's not as easy as just go hire somebody and let them do that. Um, and so what I thought was going to be a very passive investment for me turned out to be very active. I was going in there multiple times a week and on weekends, and it was another active job. And so there's got to be a better way. Like I wasn't planning on having two full-time jobs here. So
Yeah.
it was one thing to do it for a little while and get it rolling, but I didn't see the end, particularly as I wanted to continue to scale. So that's when I started moving toward, I think real estate's a better answer.
Wow, that's absolutely incredible. Even like just the like all that knowledge like that fast. It seems like it's kind of like a jumping in with both feet. Like, do you have to like really like 100% commit to it? Like you're like, this is it. Like, and like you mentioned, just to have like that extra capital for, if it isn't profitable on day one, or, not having certain people like hired, because it might be difficult and the qualifications and stuff. Like, it sounds like it's a lot of like challenges just kind of rolled up into one.
It is. And that I think that it it tends to be the way I learn and grow the best is to
Yeah.
jump in, to put
Yeah.
put myself out front, put my own resources at risk and figure it out. I'm a doer, I'm an
Yeah.
executor. And so I think some people study and never get to execution. And I think I've found a good balance of both. I want to make sure that I have a plan going in and I understand how executable it is, and then execute on it. And the best laid plans always change after you start. So it's about adjusting and using great network of people and that great network of resources, and help you ultimately achieve the objectives you want to achieve, even if it sometimes goes a little left or right from where you started. Eventually, it's about getting to the goals you set out.
That's awesome. So, just out of curiosity, like, was there other people that like you were able to go to like for questions and stuff, whether it be like people in your network or, like I guess the franchisors maybe? Like, was there like
Yeah.
kind of a guidance? Like, if you were like, oh my God, like things are hitting the fan, like, what do I do?
Absolutely. Yeah. And that's one of the great things about a franchise, at least a good franchise. And this was a good franchise. They have a lot of resources as the franchisor. Now you pay for them. Don't get me
Yeah.
wrong. You paid for those, but they had good support. They had somebody local in the market I could lean on. And quite frankly, the other franchisees really came together as a community to help each other out. So we would
Oh
we'd
wow.
meet regularly. We would talk about each of our challenges, and each of us would have ideas as to how we solve those challenges. So that was a good support system, and my professional network as a you know someone who's been in a professional career for many years. I've got great contacts in finance, in banking, and insurance, and all the other aspects of business that those all help as well when you need them.
Yeah. Wow, that's incredibly interesting. Because I was curious. I was like, like, do you buy like this franchise and stuff, and then like, are you just kind of on your own? Like, do you just have to kind of like, follow the model that like they give you or something? And then, if you have questions, like you just kind of figure it out, or
Well, there's definitely franchisors that are like that. I
yeah,
don't know if you've ever watched The Profit. I love the show The Profit with
I don't think
Marcus
so. I'll have to check
Lemonis
it out.
on CNBC. It's a great. I love the TV show, and sometimes I've seen several times actually. He's gone in with somebody who's had a concept, a retail concept, and they've immediately gone and franchised it, and their franchisees aren't being successful. And in some cases, they're not, their own stores aren't even being successful. Maybe the first one was okay, but the second one's not doing so good. Um, and Marcus always says, you franchise too early. You haven't proven the model, and you're not giving your franchisees the support they need. And when I look at what they're doing, it's a lot of what you just suggested, which is, here's the brand, here's the basics, good
Yeah,
luck.
figure it out.
And if the model's not proven and it's not codified into procedures and steps, or like, that's what you're paying for out of a franchisor. And if you're not savvy enough to vet a good franchisor, you could wind up with one of those guys that has little more than an idea,
Yeah.
and you're kind of on your own. And so I'm not sure you get the value out of that. But that
That's crazy, especially for like that amount of capital being invested, like
Yeah. Yeah, that's
wow.
right. I mean, it's not a small investment. I'd say the
Yeah.
investment in capital is sometimes pales in comparison to your investment in time.
Yeah. Time frustration.
Yeah. Yeah, exactly. So that's why real estate to me has been a much better option.
I think that's a perfect segue into kind of how you got into your real estate career right after
Sure.
that.
Yeah. So, I mean, I guess we'll kind of start at the beginning and we'll wind up of ultimately around real estate syndications, which is what I'm focused on today. So I would say, I think like a lot of people say, geez, I'd love to have a vacation home, right? That sounds great. I'll just go buy a vacation home and then I'll rent it out, and I'll make the money on the rentals, and then I can use it whenever I want to use it. And and the rents will pay for the mortgage and pay for itself. And in 20 or 30 years, I'll have a vacation home of my own that I didn't have to pay for, but I got to use. And so I thought, hey, that is a good idea. This was 25 years ago. So I went and did it 20 years ago. I went and bought a ski house up in New Hampshire at Loon Mountain, and in 2002. And it was a nice ski house, a lot of fun. And I did that. I rented it out, and the rents did not pay for itself. I would say they helped, but they didn't pay.
Cover.
It didn't pay the mortgage.
Yeah.
And what I also found is every time I wanted to use it, well, those are the times that it was rented or easily rented or rented at a high price, right? Christmas week, February vacation week, and all the other high profile times that everybody wants to rent. That's when I wanted to use it. But then I had to rent it if I wanted the income. So what I found was I wasn't renting it as much as I would like because I was using it more.
Yeah.
And then the other thing that I found is what's really different about a rental property that you use is it's your stuff, right? It's like you're using it. It's your couch and your chair and your silverware, everything that you like, you've put in there. You've made it so it's nice and comfortable for you.
Yeah.
And then you show up on a Friday night at 8 o'clock to enjoy the weekend, and you find out like somebody just put a giant oil stain in the middle of the carpet. And you're like, what am I going to do about that? Now I got to get a cleaner in here and clean it up. And because I don't want to live like that. And so
Yeah.
it's like this constant, like sinking feeling in your stomach when you walk in, you're like, what's broken?
What's
What's
next? Yeah.
missing? What am I going to have to deal with? And it's totally different if you're doing like a long-term rental or even just a short-term rental that you're not using,
Yeah.
because it's like, okay, you check in on it on some regular basis, you have maintenance done, but you're not worried as much about the little stuff because, at least for me, I like things really nice the way I like them.
Yeah.
And I don't want to live in, you know, somebody else's mess. So
Exactly.
I did that for a long time. I had that property for about 20 years and I rented it for 10. And then at that point, it got so tired from all the rentals, just worn out, that I was like, all right, I'm going to renovate it. And I completely renovated the whole house and then stopped renting it and just used it and enjoyed it. And then ultimately sold it when the market was doing really well a year or so ago,
Nice.
and made a good profit on it. Right. I made a good profit. But if I think about what could I have done with that money had I put it into, let's say, multifamily rentals back then, or even the stock market? I would have done much better in other ways. Now, I did enjoy using the place, so that's
Yeah.
great. But that's how I got started into rental properties, is through that vacation rentals.
That's super interesting. One thing that really stuck out in there was, if you wanted to buy like a vacation house like that, like having that balance of, enjoying it for pleasure and vacation, as well as like, oh, well, I could do that. Or if I want to collect, the money from it, or have it pay some of the mortgage, what have you, then, I kind of have to keep it rented out. And then like when I wanted to use it, it's a vacation, a holiday, whatever it is, like, well, I'd actually get more from it if I was renting it out. I feel like that's something that's not really talked about with
Yeah.
short-term rentals.
Yeah, especially if it's a place that you plan to use, then you start
Yeah,
saying, well, geez, is it worth $2,000 for me to use it this week? Or should I
exactly.
collect the $2,000 and let somebody else use it this week? And then when you start looking at it that way, you're thinking, well, if I had $2,000, maybe I would go do something different.
Yeah.
I mean, the other
Hmm.
thing is you wind up being really locked in to your vacation rental because you got so much invested up there. Whether, for me, it was a ski place. So you got season tickets, ski passes, you got the
Everything.
aquatic club that you're a member of, you got all your gear, you got all, it's just everything, you got everything in the house costs. Like you're just very invested. And so to think about taking a vacation somewhere else, it's like, kind of already invested over here. Like,
Yeah.
I don't know if I want to spend more to go somewhere else. So, what I love now is this freedom of I've taken that money from my vacation rentals, I've poured it into apartments. My apartments that I never go to and just want to keep fully rented,
Yep.
um, they make money, and then I use that money to go vacation wherever I want. And so for me, it's like this newfound freedom of, okay, well, we're going to do some vacations this year. Where are we going? Are we going to, and we can go anywhere. Like
Yeah.
I don't have to go to Loon Mountain anymore. Although I still go occasionally because I do like it, but there's a lot of places to go now. Florida,
The
go
sky's the
out
limit.
west, all kinds of places. So.
Yeah. That's really interesting too, like how you took that initial money and like just transferred like a couple different ways across, the short-term rental, and then, putting it into something a bit more passive. And like, I don't know, like that always blows me away. Like when you take the same principle, put it in a spot that's growing, and then move it to somewhere else, that it's growing a bit more, and like it works more for convenience. And like you said, and then to be able to extract the income from that to do the same thing that you wanted to do initially, and go
Yeah.
like on vacation and stuff. But you can do that everywhere and you still have your money. So like, I don't know, it's extremely interesting, just to kind of like move that money around and just have it grow in different places, and be able to still have the vision that you were looking for, maybe a little bit magnified.
Yep. Yeah, that whole concept of capital recycling is similar to what you're talking about, right? So the idea that you can go in and then make some money with an investment and then get your capital or a good chunk of your capital back out, either through refinancing or through a sale and profit, what have you, roll it into something else that is also a good investment. So that capital recycling is a way to kind of make your investing career have a lot of legs versus if you kind of buy one thing and just hold it forever.
Yeah.
I mean, you may do very well with it, but if you can figure out how to pull your capital out and reinvest it, now you start getting some significant gains.
Yeah. That principle is really insane. Even like I think like Robert Kiyosaki talks about it in like Rich Dad Poor Dad, I'm pretty sure. Playing with like house money.
Yeah.
Like putting your capital in and then, whatever it is, like somehow getting it out of that asset, still keeping the asset and being able to use the same amount of money all over again.
Yes,
It's just
exactly.
that's insane. Like
Yeah. I mean, and look, it's not like it's super easy to do. You have to
of
find
course.
ways to add value. Look, the last 10 years has been great in real estate in terms of just market appreciation helping.
Yep.
So the tailwinds have been there. And, I think um, you know, i- it's been more favorable in the last 10 years than it might be in the next 10 years. With that said, I still think that there's a lot of good factors moving in the right direction for a multifamily.
Yeah.
The shortage, and it depends on where you're talking about too, right? I mean, there's some areas that are growing and some areas that are not growing, and I think investing in areas with income growth is helpful. Job growth, population growth, those all create tailwinds for you, even if overall market pressures start to go the other way.
Yeah, definitely. I feel like those are really huge when it comes to selecting a market. Like wherever you're looking, like just to be able to kind of find that data, and be able to compare like one city to another. And like most of that data can be found online too, like pretty easily, like
Yep.
and it's pretty updated depending on where you go. Like if you have like a negative population growth percentage in one city and the other one is like 5% over the course of the year or something, well, that maybe could sway your decision. If there's a couple other things, other factors that kind of how those weigh each other out. So I feel like that's kind of something that's a little bit less talked about too, is to just look a lot deeper than like, oh, is this market affordable? Like, how do I feel about it? Whatever. But be able to kind of look into the data points and check out some of those things like population growth and yeah, I mean like the tax rates and stuff like that. And like just be able to kind of compare a lot of different cities together.
Yeah, and there's I think a lot of factors that go into where what makes a good investment. And in fact, I've got a short 5-part video series called the Spire Simple Syndication System. For your audience, if they want to grab it, they can at spireinvestmentproperties.com/SSSS.
Check it out,
Um,
guys.
thanks. Yeah. So 5 short videos around different things to look for in a real estate syndication or real estate, really any real estate investment. And number one on the list is markets and submarkets for all the reasons that we just talked about. You just talked about. And the thing is, there's never. It seems like there's never a perfect deal that matches everything, right? So yeah, if you want to have be in the market and the submarket, like let's just take an example, like you want to be in downtown Boston's not quite as hot as it was, but it's still, you want to be in a prime location, downtown Boston, low vacancy rates, really low cap rates, which basically means prices are really high. Yeah, that sounds great, but don't plan on having a whole lot of cash flow out of that on a regular basis. That's got to be, either highly leveraged and just hope for appreciation, or you got to have lower leverage to get cash flow out of it. And, the return on your investment could be a lot lower when you just look at it from a cash perspective. But as we all know, Boston's a gateway city. There's a tremendous amount of, even in spite of the pandemic, with a lot of people moving to southern cities and realizing they can be more mobile, I still personally think Boston's a great place with continued, draw for population, particularly with our schools, colleges, and our medical and our tech and so forth. So, pandemic aside, right? The idea is that sometimes the market that is so hot may be so expensive that it's hard to get what you want out of it. A
Yeah,
lot of institutional money comes in, and or foreign money, where they're really just looking to park in U.S. real estate in these gateway cities. Makes it a lot harder to find something that cash flows for you too.
exactly. And not even to mention, like, there are a lot of other investors that are looking for that exact same thing. that aren't like in these institutions and stuff like that. Like, people doing like 1031 exchanges and looking for literally the same exact thing that you are. Like, there's just
Yep,
the overall competitiveness to kind of look for that perfect property, that
that's right.
checks all the boxes. And yeah.
Yeah, well, I mean, and we'll talk more about syndications. A lot of syndicators, and look, I'm one of them. Would love to find the property that is, you know, hasn't had
Perfect.
rents raised in a couple of years. Kitchens, bathrooms a little tired. Maybe the parking lot looks a little tired, right? Maybe need some paint. Okay, so we can go in, we can add some amount of capital, do some light rehab, move the rents significantly, add a lot of value to the property without a lot of risk, do it as units turnover so that the cash flow continues while you're continuing to renovate. It's basically like doing a flip times 100 units.
Yeah.
You're basically flipping unit by unit on a major property, but you're doing them quick, and pretty low risk. So but those are great. And when you find them, you got to jump on them. A lot of times what's happens, because everybody's looking for them, you're going to be paid like all that's already done.
Yeah.
And so if you're already paying for it to all be done, there's nothing left for you to add value to, because you
Yeah.
paid for it before you started. So it's challenging. And I guess to bring it back to full cycle, I think some of those more expensive markets now, the places to find your opportunities are in distressed assets,
Yeah.
because they're harder to buy, right? So a distressed asset that's not, may have 30, 40, 50% vacancy or 100% vacant, an asset like that has a lot less suitors. I mean, people need to figure out how to get a capital stack to buy that when there's no existing revenue or poor revenue, and be able to turn it around. It's a higher risk situation. So those, I think, in the hotter markets, those are still where you can find the opportunities, unless you just pound the pavement so well that you get lucky on one of the other ones. But uh,
Yeah. Yeah, definitely. It's really interesting. Like, now that you say that too, like when you see some of those distressed assets out there, like the ones who take a crack at the challenge and try and figure it out are, I'm sure you see it quite a bit, are some of the ones that it can really pay off for. And other than people like just getting like scared and nervous by it and like, all right, screw that. Like, let's just keep looking, like let's not even bother. But the ones who are kind of daring enough to take on that challenge and figure out, where those issues lie and figure out how to solve those.
yeah, that's right. I mean, if they were all easy, everybody would do it, and everybody's looking for the easy ones. So sometimes the rewards are in the harder ones. So yeah, and look, the more you dig into them, the more you try to figure them out, the more you learn, and then whether that one works out, you take that, you roll that knowledge forward to the next one, and um, eventually you get one figured out, and you make it work, and you get the rewards that you would hope for.
Yeah.
At least that's the idea.
I feel like that's really the commodity is, that knowledge that you get from all of those experience, whether they're good or bad, and just be able to keep stacking that, in every situation that you're in and just picking little things up here and there, like you said, to take on to that next property. And if you didn't learn something like that from like two experiences before, it might happen now. But because you learned that like two failures ago, which I don't even really look at something like that as a failure, more of, I guess, an experience. Um, and then you'll be able to be a lot more familiar with that situation, to be able to fix that problem. I'll be like, oh, I dealt with that, a couple houses ago. Like, let's do it. Let's get it done.
That's right. That's right. Yeah. I mean, it's funny. One of my fellow partners was just telling a story to an investor group about his first property he had under contract, and he walked away during the inspection because they found mice. And he looks back now and says, "Oh my God, that was just an exterminator call away to fix it." And I walked away because they found mice. I didn't know how bad the mice situation was going to be.
Yeah.
And so I would like to think many people would not be so scared of mice, but I think it's also just sometimes daunting when people want to get into it, where they're like, it's a big investment, it's a lot of money, and they'll almost look for any excuse that's not perfect to give
Yep.
them an out, because it's just not comfortable for them yet.
Yeah.
And so I think that's why it helps to partner with people. in this game. Real estate, I've often said, is a team sport.
Yep.
It's takes a lot of people, particularly to do bigger stuff, but even smaller stuff. If it's all what's big to you, right? So I worked for real estate investment trusts that had 30 billion in assets under management. Well, that's pretty big, at least to me. But
Yeah.
there's some people, there's some companies out there that might not think that's so big. But as an individual, that seems huge. And you know what? That $200,000 duplex might seem huge if you've never owned a house before. So it's all relative. And I think, at least for me, I've always found that finding great mentors, great partners, great network of people can really help you get out of your comfort zone and take those steps that, if you don't take them, you'll just never go forward. So,
Yeah. I feel like that really is huge too. I want to stem back to something you mentioned a little bit earlier about like the mice kind of thing. So like just kind of like the principle with that, of like just kind of like as you're walking through the house, whether it be during the inspection or whatever it is, and you find something like that, that isn't really desirable. It's really easy to just get terrified and then just walk away and be like, all right, no, I'm not going to deal with that. But again, it's the ones who actually like go and try and figure out that problem, and see how you can make it work. Like I've found a couple times, like I'm still experiencing it myself. I unfortunately walked away from a couple, but yeah, I mean, like just being able to kind of have those people to ask those questions, and like something
right.
that in your head, might be throwing off a bunch of red flags. Like you ask them and they're like, oh, that's no big deal. Like
Right.
I've done that like 3 times. It's like you just mentioned a minute ago, like what looks big to you, in the position that you're in. If you've been renting an apartment your whole life, or you're a teenager or whatever, buying a house looks absolutely scary as hell. But if you bought like a 2-family or something, a 4-family might not look that bad. And then all of a sudden, a 6 or an 8 comes in. Yeah. You already have your process. It's just, adapting.
Yeah. Just
And
add
just
zeros
kinda,
to the check.
yeah. Hopefully on both ends.
Yeah. Right. Right.
But
Yeah.
yeah.
Well, I mean, it's a good point, So I look at every time a challenge comes up on a deal, I try to solve it.
Yeah.
And I, there's nothing wrong with walking away if you can't solve it. And that gets back to, for me, it's about having good analysis, good due diligence, good business plan going in, and then executing to the best of your ability.
Yeah.
But in order to get good analysis, good business plan going in, you got to try to solve the hard problems. And even if you don't solve them, you probably learn enough that maybe you solve the next one. And sometimes you got to solve them in a time frame that doesn't work because you got to close or what have you, and you have to walk away. And I would much rather, for me, I'd rather walk away from a deal that I'm not sure how to execute
Yep.
than to get into it and just kind of hope I can figure it out.
Yeah.
But it doesn't stop me from trying to solve every one of the problems, because the next one that comes around, then I'll know what to do. Because sometimes it just takes longer to find the right people or find the right solutions or find, the right financing or what have you. So,
Yeah. I couldn't agree more. It's like one thing that I'm starting to kind of like figure out is, where the line is between, dealing with a lot of those problems and like doing that, trying to figure out some of those answers, as well as it not really making sense as an investment anymore
mhm.
and walking away, like kind of where that line is. And obviously, it's going to be situation specific, but
Yep.
like, at what point do you find out, like, if there's like $40,000 worth of, repairing joists or something like that in a basement, like, and you have to pay for that, if like the seller doesn't want to move or whatever it is, does that still make sense as an investment? Like, is it even worth it to kind of go back and forth? Like where's the kind of like the teeter point, I guess, of going to fix this issue
Yep.
and then also walking away because it's in your best interest because the property doesn't work as an investment anymore, or it doesn't fit that goal that you're looking for.
Yeah. Look, if the property doesn't fit your goals after you discover that sort of thing, absolutely walking away is the right answer. But I guess for me, I wouldn't get scared of $40,000 of joist damage in and of itself. I
Yeah.
would say, okay, there's $40,000 of joist damage. Do I know it's $40,000? What kind of contingency on that? Should it be $50,000? Okay. And by the way, I'm also going to be taking extra risk doing this. So I better be getting this property for 60 or 70 or $80,000 less, because
Yeah, to combat.
otherwise, why wouldn't I just buy a property that doesn't have this choice problem? Right.
You're right.
So I should make some money for my trouble of taking on this problem.
Yep.
Right. And work with the seller to see, does that work for them? Do they understand that they have a choice problem? Do they understand that they won't be able to sell this house at the price they thought because of these issues? And some of them will, and some of them won't. Some will say, it's a really hot market. Somebody else will buy it and I'll get my money one way or the other. And, they can kind of do that in this market.
Yeah.
And then I'd walk away.
Exactly. Yep.
But just because I found $40,000 of damage or repair needs wouldn't bother me.
Yeah.
I mean, I've gone into some properties where we've needed a lot bigger capital investment than that, $1 million of capital investment. And, but that's part of the business plan. That's why we can make money on the properties. And this was, 70 unit properties. So we're talking about new roofs, restriping parking lots, redoing, interior flooring, updating kitchens, baths, a lot of things but ultimately the business plan shows we put that capital in, we raise the rents, and now we've built a lot of value in return for putting that capital in. So in fact, I actually am not that interested in properties that I can't or don't need to put a lot of capital into.
Yeah.
Because if it's already kind of everything it can be,
Now what?
you're only going to make kind of what it makes today, which, they're going to price it for that. So,
Yeah.
so for me, you got to find the one where you can put some capital in, increase the value, and get a return on your investment you've made.
Of course, yeah. And like oftentimes too, to your point, like if people have a house or, like a big property or whatever, that's cash flowing fine, everything's all, market rent, everything is literally fantastic. Why are you going to get rid of it? Like there's probably a reason that they're going to liquidate that, so
Yeah.
like just kind of finding, I don't know, it doesn't really make sense. I mean, like everybody's situations are going to be different, but like, why would you sell a property that's like literally everything is great, like
Yeah.
instead, just to, like you said, like to find those properties where the market rent, or it's like a couple $100 less than the market, or maybe more than that, whatever. The rents that are in there are a lot less than what it can be rent. I'm choking on my words today. The rents are a lot less than what they could be, basically.
Right.
And be able to put that equity in there and like update the units and like, just make it a lot more worth it, and giving the tenants a lot more value as well for the price that they would be paying. Sounds like it can be really rewarding, if depending on how you play your cards.
Yeah. I mean, so boy, it's ideal when you can find a place that has below market rent that doesn't really need anything, and all you can do, you just go in and raise the rents. But man, those are really hard to find, right?
Yeah.
So what tends to happen is, they're fully leased, they're making money, they're just below rent. If they're a smart seller, they're gonna consult, a broker or somebody that's going to know the market, and they're going to price it like you've already got the rent increase in there.
Yeah.
And then, so why would they sell? Well, they're going to sell. Well, geez, I'm getting basically a premium for my place. And, some people are worried about, are we in a real estate bubble, or are we on the other end of the cycle? Or, or maybe they moved out of town. They were self-managing. They moved out of town. They're not really inclined to use third-party property management. So there's kind of a lot of reasons people would sell stabilized assets, but they're hard to get at a good price if you can't find a way to infuse capital and make them add value.
Yeah.
I think that's what I found anyway.
Yeah, definitely. It's really fun to kind of think about too, and especially in this market that we're in right now. People, like everybody and their mother knows that, you could sell a house at a premium. If you're in the seller's seat, like you're doing pretty okay,
Yeah.
and like a lot of eager buyers out there, whether they're like first time home buyers or investors, big investors. Like everybody kind of knows the cards that are out right now. And just to kind of see like when they want to cash out or whatever the plan is.
Yeah, and there's a lot of people that have been invested a long time in their assets, and they're at a place now where they want the money out because they want to go do other things. They want to retire, they want to travel, they want to do stuff with the grandkids, who knows, right? I mean, they're just people sometimes they're just looking to do something else. So and then unfortunately people pass away and pass their assets on to the kids, and the kids like, I
I don't
mean,
want this.
my dad used to take care of this building and he was always over there fixing toilets and I don't want to do that. I don't really know anything about it. I'm a doctor or
Yeah.
anything. Just I don't want to do that stuff. So, there becomes opportunities. And that's the thing. It's about finding good opportunities and seeing what you can make of them, and then building a business plan and going after and doing it. And you're gonna get way more no's than yeses. If you're getting all yeses, you're probably paying too much.
Yeah.
And you'll be unhappy later. But because it's not easy.
Yeah, definitely. Like even like to stem back to what we were talking about earlier, about like even getting things under contract and having to walk away, like
Yep.
just and extracting the knowledge from that. And whether like you're only into it for like the price of your inspection or something like that, but the lessons you learned from it, you're able to carry on to the next one. I feel like that's kind of the same with some of these like off market and on market actually opportunities, to even like just to kind of create those opportunities. And like, if things don't work out, okay, that's kind of the I guess like the gist of it. I mean, most of these aren't going to work out, but some
That's
of
right.
the opportunities that like, even if you're able to go and, walk through or whatever it is, and, the seller wants like a ridiculous amount, just to extract, some of the lessons and like why he wants that amount, and like, what's important, and like really just the psychology of it, and to be able to extract those lessons as well, to be able to keep carrying on to those next properties, and eventually you're going to get a couple, just from all those compounded lessons just kind of built together, um and just making moves.
Yeah, I'll just give you a great example of that, at least from my own recent experience. So I'm working with a partner on a startup called Sweet People, and what we're looking to do is convert hotels into micro housing. So
Ooh.
our thesis here is that there are hotels, particularly those in cities, that have catered to business travelers that have had a tough time over the last year, where business travel is down, and I think it's not coming back as quickly as, well, I just don't think it's coming back very quickly at all, to
Yeah.
be honest with you. So these hotels, I believe, represent a good price point for the asset, that if we can convert it over to multifamily housing, and specifically micro housing. So in this case, very small footprint for the units, but still fully and full suites. So 5 appliances, private bathroom, high-end design, efficient furniture. Uh, and then common amenities in these buildings. So whether that be pool, bike storage, other storage, restaurant on the first floor, home theater room, or, theater room down there, um, those types of things. So really great amenities, really great style, small footprint, and a good price point over what you might get around there for as a renter, as a tenant. Um, that's our thesis. So we're bidding on properties all the time. And our first one that, man, we thought we had it. We had a great design. It was a great building. It was in Chicago. It was empty. Um, we put in what was the highest bid, and we were told we were the highest bid. So we're like, this is great. We're
Yes.
gonna get this. We're gonna do it. Yes, right. And it was a huge investment
Yeah.
in terms of both the rehab to get it to where it needed to be, and all, and the cost of it, and all that stuff. So it was a big project. It can be a lot of fun. And the seller went with someone else, and I was like, what's going on? Why are they going? We had a higher bid, and for them it was our timeline. We had a timeline that was going to be, we asked for 3 months. Truth is, it could have been 6, because we're looking to get through some zoning stuff. I mean, there's a number of things. This wasn't turnkey because it was a
Yeah.
hotel. There's some parking. There was a number of things we had to work through. And they went with a lower bidder because that bidder, well, it had a fund and they had the money and it was going to close, right?
Oh,
Close
gotcha.
fast. So what did I learn from that? I learned I need to figure out how to close faster. I need to, right? And I need to figure out financing and things like that to be able to show that I can execute that quickly. And so we've made a lot of progress looking at different funding alternatives, different partners we can bring in. And so we're continuing to bid, and we're taking, that experience, that, that loss, and we're figuring out how to be better on the next one. And we're just going to keep doing it till we get a good one at a good price.
All right, guys, that concludes our Creating Wealth podcast episode for today. I want to thank every single person that has listened this far. It really means a lot to know that people can learn from me and with me as we build wealth together. Hopefully, you can take home at least one thing from this podcast that will improve your life just a little bit. If you could, please check me out on social. That's at Kyle Curtin Real Estate on Instagram, Facebook, and I'm on Biggerpockets. Until next time, let's build together.